A really strong performance for the job market in the month of May. In fact, 3 months in a row of strong job growth after kind of a shaky start to the year. The unemployment rate is still 4.3%, which historically is considered a good number. So that's a lot of hiring, and it's pretty broad-based. Healthcare is still leading the way. Leisure and hospitality, a bunch of jobs expected to come in here because of World Cup hiring, believe it or not. But you had financial services jobs shed in the month. Something to watch there. Those tend to be higher paid jobs, insurance kind of jobs. Another really important wrinkle to consider in this number is wage growth. Wage growth of 3.4%, that's less than the inflation rate. That means the paycheck is not going as far as it used to. It's eating into the purchasing power. That's part of the affordability story that we're watching very carefully. So what does this mean for policy? It means potentially the Fed could be in a position to raise interest rates, not cut them later this year. That's certainly what the markets are telling us. They're pricing in the expectation the Fed might have to raise interest rates because this strong job number means the economy is in a good position here. Even as inflation is still churning, that might put the Fed in a position to have to raise rates. And that puts Kevin Warsh, the new Fed chairman, in a really tricky position. He was tapped by President Trump to come in and slash interest rates. He might be in a position with the other voting members of the Fed board where they feel like they have to raise interest rates. That could set up Kevin Warsh for his own conflict or controversy with the President of the United States, just like the former Fed chief. A word about the stock market here, recently setting record highs again and again. Today, concerned about those expectations that the Fed might have to hike interest rates sometime later this year to contain inflation. Higher interest rates, of course, raise costs for businesses, especially you look at tech stocks that are part of the market that does very, very well with lower interest rates. Context, remember, very close to all-time highs recently made. And of course, many people have been hoping for lower interest rates, and certainly a lot of people in the housing market had hoped that interest rates would fall and mortgage rates would fall too. Higher interest rates, if they were to come, of course, that means higher borrowing costs for anybody who's borrowing for a car, a student loan, a mortgage, a personal loan, companies borrowing money. That's one reason why higher official interest rates tend to spook the stock market.